Welcome to your Weekend Mortgage Minute, powered by the Hopkins AI News team. Let's get into our Weekend Mortgage Minute. Hey everyone, it's your Mortgage Rain Man, John Hopkins AI twin here with the Hopkins Lending team, powered by the broker. Welcome to your Weekend Mortgage Minute. There was a ton of activity in the market last week, so let's take a look at exactly what happened, why it matters, and what it means for you. Let's start by digging into the data. For our weekly data deep dive, let's turn it over to Sterling. Sterling, what do you have for us?
We got some eye-opening jobs data this week. Only 73,000 jobs were added in July, and May and June were both revised downward sharply. Over 250,000 jobs cut from prior reports. That shook the bond market. The 10-year Treasury yield dropped, which nudged mortgage rates down. The average 30-year fixed ticked down to 6.72% from 6.74%. But let's zoom out. The Federal Reserve held rates steady again, just like the market expected. What matters more is what Jerome Powell actually said. We're encouraged by inflation progress, but we're not there yet. Translation, no rate cuts yet. The Fed wants to see more weak data before it moves. And remember, mortgage rates don't follow the Fed directly. They move based on investor demand, inflation expectations, and risk pricing. So even with softer job numbers, we're not in rate drop territory just yet. Now, let's jump over to Dottie on some housing and more localized data. Dottie, take it away.
Thanks, Sterling. Here's how Virginia Beach and Hampton Roads stack up. The sale-to-list ratio is 99.8%, meaning homes sell only slightly under list, stronger than the 99.3% national average. Median home prices are up 4% to $375,000, ahead of the more moderate pace nationwide. Listings are up 10% year-over-year locally, giving buyers more options, though national inventory is rising faster. Month supply remains tight at 1.7 months. A deep seller's market continues here. Bottom line, while national indicators show cooling, local pricing and pace are holding firm. That gives sellers confidence and buyers reason to act strategically now.
Thanks, Dottie. So here's a stat not enough people are talking about. FHA delinquencies are now at 10.7%. That's nearly 5 times higher than conventional loans. And that scares investors, because when investors see elevated delinquency risk, they demand higher premiums on mortgage-backed securities. So even though Treasury rates dropped, FHA and VA borrowers may not see meaningful relief in their actual rate quotes. Looking ahead to this week, we're not expecting any major data drops. No Fed meeting, no CPI, and no jobs report. This means markets may stay in a narrow range. Most analysts and investors are expecting mortgage rates to stay relatively flat or shift modestly depending on bond market sentiment. If bond yields stay soft, we might see another small improvement, but don't expect a major move without new data. Before we sign off, let's take a look at this week's Mythbuster segment. Echo, what myth are you buzzing this week?
Thank you, John. Myth: if the Fed cuts rates, mortgage rates will drop immediately. This is false. The truth is, mortgage rates don't just follow the Fed. They follow investor demand, risk pricing, and MBS spreads. Right now, those are being held back by fear, not the Fed.
So here's the takeaway. The Fed's not cutting. Investors are still nervous. FHA delinquencies are high. Rates dipped, but just barely. And that's why buyers waiting for the big drop may miss their moment. What's changing faster than rates is buyer leverage. More homes, fewer bidding wars, longer days on market. So let's build a plan that works in today's unique market. Not next quarter, not next year, but now. Well, that's all we have for this week. This has been John's AI twin, your local expert, the Mortgage Rain Man, Sterling, Dottie, Echo, and Valor, saying have a great week. If you enjoy these updates, please hit that subscribe button or like and share with friends. Need a plan or have questions? We're always here to help. Thanks for joining us. See you next week.